Hello, I'm Christian, and welcome to the Jamoir Leadership Podcast, a show where we talk about effective collaboration, influence, and leadership in an increasingly complex world. My interview partner is Dr. Dirk Schlimm. Dirk is an international leadership expert and the author of Influencing Powerful People. The purpose of this podcast is to share ideas and stimulate discussion, and it does not constitute professional advice of any kind. If such advice is needed, the services of a competent professional should be sought. The speakers, host, and Jamoir International Incorporated are not to be held responsible for any use, misuse, or reuse of the content. Enjoy the show. Welcome to the Jamoir Leadership Podcast. For today, we had originally planned an episode that talked about Nordstrom, the American luxury department store chain closing its stores in Canada. But then in the course of this week, a much bigger closure hit the business news, and that's the collapse of SVB Financial, which is the parent company of Silicon Valley Bank. The demise of the Silicon Valley Bank has sent shockwaves through both tech industry and the financial services industry. And this in turn has prompted televised reassurances from firstly the US President Joe Biden, who said the US banking system is safe, and a statement from the Bank of England that the wider UK banking system remains safe, sound, and well capitalized. I should also add here that even I received an email from my online investment management service advising me that my money was safe. They even added to the first line, RIP SVB, which may sound a bit tasteless, but definitely reflects the gravity of this news. So given all that we have heard about this collapse, we decided we would do a special episode on the story of the SVB Bank. And today, we'll cover that, while next time, hopefully, we'll pick up on Nordstrom Canada and discuss that. So, Dirk, who is Silicon Valley Bank, and why is this story such a big deal?
Yeah, thanks, Christian. So Silicon Valley Bank is, or we should say now, was a bank based in San Francisco that was focused on doing business with startups, especially technology startups, the kind of companies that the Silicon Valley is known for, and hence the name Silicon Valley Bank.
Okay, Dirk, great. So what's so special about them?
Well, Christian, banks by their very nature, as you probably will appreciate, can be risk averse. And it can be hard for a startup to get bank financing because their business is uncertain, or they do not have any assets which they can put up as collateral to secure loans. So typically these kind of the banks will ask for that kind of collateral. And so SVB stepped in, or if you will, stepped up and really carved a niche for themselves, which made it very successful. They were lending to these startups, and that with the growth that accelerated, or one could even say turbocharged during the startup boom in the past years, that was very successful. And so SVB became the 16th largest lender in America with over $200 billion in assets, and that's really a big deal.
Yeah, Dirk, sounds like a big deal and a fascinating story behind that. So what went wrong here?
Yeah. So first of all, Christian, you're right. It surely looked like a big success story until recently, and the actual problem, however, if I can put it like this, stemmed from the somewhat or very counterintuitive thing that the bank had too much money. That turned out to be the problem.
Yeah, Dirk, that does sound incredibly odd. Could you unpack that for me?
Yeah. So in the startup boom over the past years, which very much continued through the pandemic, and in some areas even accelerated in the pandemic. So you remember that many tech companies really took off during the pandemic with things like video conferencing, for example. Those became very, very hot things very, very suddenly. And so venture capital, or VC firms, as they're known, they pumped a lot of money into these startups, and so much so that these startups needed actually deposit that money that flowed in somewhere. And it's a good time here to remember that a bank, at its most basic, I mean, the financial industry is very sophisticated, but at its most basic, a bank does two things to facilitate business. It is a place where people can safely keep their money, and it is a place where they can secure loans to conduct their business. And so in this case, and somewhat unexpectedly, one might add, SVB, instead of being mainly a lender for startups, became a place where startups kept their money.
Okay, Dirk, that doesn't necessarily sound problematic to me. What happened then?
Yeah, what happened is that SVB invested that money themselves by buying interest-bearing assets, so such as bonds, to earn a return on all the billions of dollars that they received. They just didn't have them lying around there. They bought bonds, so if you will, lent the money to other people, and they bought assets that are considered very safe, things that you know where you will get your money back. So safe deposits like U.S. Treasury bonds. So by no means anything that would have been considered speculative.
I'm not a banking expert here, Dirk, but that seems like standard practice to me. Why was this a problem?
Yeah. So the problem now, we're actually getting to the problem. These bonds and similar securities that they bought, they were very safe. And so by safe, we mean that there was virtually no risk or very low risk of defaulting, which is banker speak for getting your money back. But they bought those bonds and securities at a time when interest rates were very low. And in order to earn a bit more money, they locked them in for a longer time when they then lend out, if you will, the money to other people.
Okay, Dirk, I'm starting to see what's going on here. So in essence, they borrowed short-term money from depositors who could ask to be repaid at any time, and then invested that in long-term assets that are impossible, or at least incredibly difficult to withdraw from when they are needed all of a sudden.
Yeah, Christian, that's exactly it. Because when all of a sudden interest rates went up, which they did due to inflation, everyone with a conservative or safe portfolio, say a retirement portfolio, saw the value of their portfolio go down because they now had low interest bonds locked in for some years in their portfolio, while at the same time, one would be able to buy new bonds at much higher interest rates. And so the prices of these locked in bonds went down.
Got it, Dirk. But just reflecting on that, couldn't SVB just waited for interest rates to come down again and for things to normalize over time, I suppose?
Yeah, a Christian, that's true, and that is exactly what will happen with people when they look at their retirement portfolios. The investment advisor will tell them, "Hey, we wait this out. Interest rates come back down, and so over time you will be okay, so to speak." But that was not what happened here, because now we're in this new macro financial environment, if we call it that, high inflation and more uncertainty and all of those things, higher interest rates. And so now all of a sudden it became much harder for these startups that for a time had too much money, if you will. Now it becomes all of a sudden hard for them to raise funds from venture capitalists or through public offerings.
Right. And so they wanted their money back.
Exactly. And now SVB had the money locked in, and the securities that they had bought had lost in value. And so they could not pay their customers who wanted their money back now. And so they ran into trouble. And this is when the bank regulator stepped in. And SVB had become so successful and grown so big that they had become really a major player in the financial system, and especially in the startup and the tech industry. And it's really, therefore, what we would have to call a massive failure compared to the financial crises of the past. I read one report that it is the second largest bank failure actually in U.S. history.
Wow, Dirk, that is a big deal. And I think we all now have a very clear and vivid picture of why this is such a big story. And again, that makes it all the more interesting just thinking about that note that I received from my own investment service commenting on this right away. And presumably, just thinking more about this, the same problems could exist with other banks. And that's what regulators are stepping in to contain right now.
Yeah, exactly, Christian. And that's what's going on right now as we speak. Yeah.
Got it, Dirk. So we're living through some history, and we'll all have to wait and see how it plays out here. And at the Jamoir Leadership Podcast, we're always looking for practical lessons from history, and we're living through history right now, it sounds like. So let's think about managers who might be listening to this podcast, or people in other positions. And that includes perhaps seasoned individuals, or perhaps managers who are new to their responsibility. And while I'm sure that bankers and financial people are learning a lot from this crisis with SVB, and for some other time, we might want to talk about that. Let's just think about perhaps some generic practical lessons that we could draw from this. Dirk, what do you have in mind?
Yeah, Christian, that's a good question, and you're right. There are a lot of lessons here for banks and treasury operations, which in companies, which is the activity of making sure your company has the financial resources it needs to operate, and that's can be a very complex field. But more broadly, I think there are really three things here that any manager can learn as we follow the SVB story.
All right, Dirk, let's start with number one. What is that?
No, the first one is indeed that you need to manage your money well. And this is a key for us as individuals with regard to mortgages and retirement portfolios, but it's also, of course, for businesses. And SVB is really a reminder, in my opinion, that the basics of financial management still matter, and they matter quite a bit.
Okay, Dirk, so can you unpack that for us?
Sure. So more recently, the people in the economy had really gotten used to what's called easy money. So money that you can get at very low interest rates to then invest in your business. And so people weren't quite as worried about anymore having access to money to run their business. And it even became popular at some point to say that companies run on data. We heard that a lot, and there's a lot of truth to that. But ultimately, the lifeblood, if you will, of any company is cash. And cash is money that you can use right here, right now, to pay your employees, to pay your bills, and to keep your business open. And you need to be able to pay your bills when they're due, or you go bankrupt, even if you have otherwise a good business. And so you can be a very successful business on paper, so to speak, but you run out of cash because, for example, you can run out of cash, for example, because you cannot access the money you have invested. Or more broadly, you cannot convert your products that you sell into cash quickly enough to pay your employees or your suppliers. And so cash matters, and you need to keep a close eye on it. And that's why, in a way, it is a bit shocking that SVB, a bank, right? So money people fell apart because they made a mistake in their treasury operations, something that they really should be experts in. And I'm sure they are professionals, and I'm not here to judge them at all, but it just shows how important that really is. You need cash available in sufficient quantities to run your business. And I think that's a big lesson to remember, or maybe for some of our listeners to learn, especially if you have only been managing during a time where credit has been widely available.
Okay, Dirk, hearing you loud and clear. Businesses run on cash, and when you run out of cash, you are in trouble, even if it otherwise may be good business. What's the second point?
Yeah, the second one is really related to the first one, and it shows the danger of growing too quickly. So SVB has been around for some time, but they really took off very quickly during the time of the big tech boom, and lots of money was looking to be invested due to the low interest rates, and this is how they accumulated these massive deposits, and so this kind of fast growth can be a problem for any business for a number of reasons.
So, Dirk, you're going to have to explain that some more. Isn't it good for a business to grow? And I'm thinking here, the faster, the better. I mean, isn't that what makes business exciting for people versus a steady as goes kind of view or story, which sounds kind of boring?
Yeah, and Christian, so let me say this first. Sometimes boring is good, but let me tell you why. And so first of all, if a business grows super fast, it can run out of cash, which was really our first lesson. And so let me give you an example. A business all of a sudden sells a record amount of products, but then customer will only typically pay you much later on. And so, 60, 90, even 120 20 days. And in the meantime, you have to buy supplies and you have to pay people who make all these products. And so if you have this kind of explosive growth, the business all of a sudden needs lots of raw material, lots of inputs. And so you have to pay so many people, or you have to pay for temporary help. And so the bills are piling up. But the money from all the customers doesn't come in fast enough. And so that's why during an era of fast growth, there is a bigger risk that maybe customers, they change their minds, something happens, or you cannot keep up. They want the product faster. And so then you don't, again, get the money fast enough because you have grown so quickly. And so that's the financial aspect, but there are other aspects as well.
All right, Dirk, hanging on the edge of our seat. Tell us about those other aspects.
Well, so if you're growing very quickly, for example, you may not be able to put in the infrastructure that you need to support so many more customers. You may hire too many people too quickly. Some of them may be the wrong people, or it's very inefficient because you don't have the processes, you don't have the technology that you really need to handle all of that volume efficiently. And then there's also, even if I get all of that organized, there is a brutal reality that working in a large company can be a lot less fun than working in the startup when we first got going and the people knew each other and everybody went out of their way to help each other. And now it's more transactional and it's more bureaucratic, and somehow it's just not the same anymore. And so while some people may think that getting the business to grow is a problem, which it obviously can be, managing that growth well can be just as big a problem. And sometimes going a bit slower may actually help us to build a more solid company in the long run.
Dirk, that makes a lot of sense. Growing too fast can be very problematic. So what's our third lesson here?
Yeah, the third one here is really piqued my interest, and there was a really interesting statement from the CEO of the SVB Bank, and as I mentioned when we started, SVB helped a lot of startups and helped a lot of businesses that would have had a difficult time getting loans from a traditional big bank. And it's not uncommon for businesses to complain about their banks, that they're keen to lend the money when things are good, but then to call in their loans and create problems when things are not so good. And there actually have been, at some point, there were in the US court cases around this, the questions whether a long-standing relationship creates a special duty to support your borrower throwing a rough patch.
And does it?
Well, no. So as far as I know, it doesn't, unless, of course, there are like special circumstances or violations of some specific obligations that might have existed. But typically, it's not the case. If they have the right to get the money back, they can call the loan back if that's what the contract allows them to do.
Gotcha, Dirk. So then, thinking back, what was that statement from the CEO of the Silicon Valley Bank?
Yeah, so the CEO of SVB, he urged his clients in a statement to, and I quote here, to support us as we have supported you. And that was so interesting to me because it really showed the role reversal in this case. And the first role reversal, if you will, remember we talked about this a moment ago, were that clients were depositing money, lots of money, rather than borrowing money. And that created a problem. And again, some people might have a tough time thinking about too much money being a problem, but you especially have to remember if it's other people's money, not your own money, you always have to be extra careful, right? If you have too much of other people's money, and they will want it back at a convenient or inconvenient time, that creates a problem. And then the other one is that normally, again, the bank's clients are the ones who complain that the bank is not supporting them. But here's the bank is saying that they needed the support of their clients or their customers.
Yeah, Dirk, that sounds like a bold call for help. So the natural question I think we're all having is did they do it? Did they get the support they needed from their clients?
No, they didn't.
Oh,
And those companies, they wanted their money back, and they wanted it now. And this is how we ended up here.
so Dirk, thinking about that, what's the big lesson here?
Yeah, Christian, the bigger lesson is, and probably that is what somewhat removed from the story here, is that trust and relationships matter hugely in business, and they cannot be taken for granted. There will always be business partners with whom you have a better relationship, who do not want to extract every last dollar, who do not ask you for that 100-page contract and so on. And these are valuable relationship. And this is so important because as a business, you will have some customers or some other partners that are really great customers and really great partners. And you really want to hold on to those and serve them well, even if they're not complaining. And then there are others that complain constantly, and they want a discount and a reduction, and they hold you to very, very onerous contracts.
So Dirk, do we not want those customers then?
Well, I think as a business, you always have to be very careful before you don't want a customer. But yeah, I think as your business grows, you may ask yourself whether it isn't better to focus on good customers and grow a bit slower, which is something you want to do anyway, as we just discussed. And rather than have customers or partners who make your life miserable, or where you just don't have the right product or service to keep them happy, because you're ending, you may up ending up ruining your reputation. Or when you do get into a bit of a jam in your business, you have people who are piling on immediately. So I think you want to think about that.
Okay, Dirk. So give us some practical advice. What would you do?
Yeah. So at a minimum, I think a business should be careful that we don't overcommit ourselves. So at a certain stage in your business, you may have too much choice as to who your customer is or who your bank is, but at a minimum, I think you want to be sure that you don't lock yourself in. So you may have to accept a lot of downside in a contract, for example. Just you're starting out and you can't be picky, but even then you want to be sure that you have an out. And I've seen supply contracts that do not have an out, and where the company is beholden to that customer forever, even if it doesn't make sense anymore. So I think the basic minimum is to preserve the right for your business to choose with whom you do business, and that you then really value your good and trustworthy partners, and you make sure that you're a trustworthy partner for them yourself. And I might add, this is so much more fun to do, working with people and with businesses who are reliable, who are not trying to squeeze every penny out of the relationship, but working with people who you can trust and whom you can respect is just so much more fun. Yeah.
Dirk, that's a great word. And in general, thanks for that. And thank you for those 3 lessons that we could learn from this Silicon Valley Bank crisis. And these have been general lessons that I think will help managers in whatever position they find themselves. And it's interesting, the Silicon Valley Bank story has received so much attention. And I think as we're following this, it will continue to receive attention. So we'll keep track of it and see what else we might learn.
Yeah, Christian, thanks. I'm really glad we had a chance to talk about it here.
Oh, that's wonderful. And Dirk and everyone listening, that brings us to the end of this very spontaneous episode. So as always, let me take a look at our notes here and summarize quickly. So our 3 main takeaways here were, firstly, managing the cash flow of your business is very important, even if you have a good business. A business needs to have a close eye on cash, both in good times and in bad times. Our second point, while business growth is exciting and we want our businesses to grow, growing too fast can bring all sorts of problems that can actually weaken our business in the long run. We need to decide the right pace of growth and not be driven by what we might necessarily think is exciting or fantastic in the first blush. Our third and final point is trust and relationships matter in business. And the more we can deal with trustworthy and reliable partners who are looking for the win-win and want to be successful while being successful themselves, the better. We might not always have the choice, but we certainly do not want to be dependent on an unreliable partner. Dirk, what do you think?
I think that sums it up well. Thanks so much, Christian.
And thank you so much, Dirk. And thank you so much, everyone listening. That's been the episode on the SVB Bank. Hope you enjoyed it. Please let us know what you think. You could always hit us in our contact page. The link is in the description down below. And if you have any suggestions or ideas for future episodes, we'd love to hear that as well. A like or a rating on your podcast app also always helps. We want to grow this community, get more people talking and thinking about business, management, and leadership. But that's all the time we have for today. We hope you will join us again in a couple weeks when I hope we'll revisit that interesting sounding case with Nordstrom Canada. But until then, take care.